All right, traders, I want to welcome you officially to the beginning of this deep dive on the D1 entry system. I know a lot of you guys are excited for this. I know that I've been talking about it, hyping it up for a while, so I'm excited to deliver the information to you guys. The first thing we're going to do, as usual, is I have a little agenda to kind of lay out the game plan of today's presentation. Now, like I said before, this is going to be recorded, so you'll be able to go back and rewatch this. So we're going to go through a lot of this information fairly quickly because there is a lot here. It's over 100 slides. So Facebook off, phone off, put the kids away for a second if you can, and full focus with me. We're going to get through. The first thing we're going to do is I am going to update everybody on the D1 entry, specifically about the trigger signal. We're going to talk about the 1-minute time frame and the 15-minute time frame and how they're working together, not only to line up D1 and A1 entries, but also to give us even safer entries than what you've seen so far in the advanced course. We're going to dive deeper into that. That's really the main focus of today. Like I said, we're also going to go over the D1 and the A1 working together. And I want to spend some time reviewing really good trade setups so you understand what those look like. We're also going to spend some time going over some not so great trade setups because in my opinion, they're even more valuable than understanding what the good setups look like. So we're going to do a little bit of both here so you guys can feel like you're walking away with, all right, I'm not going to trade every signal I see. I know how to find the better ones. That's the goal. So before we get into the D1, I want to talk a little bit about the A1 system because the A1 is the foundation for everything that we do. The A1 is what built the D1, and without the A1, you're going to miss entries. So you have to really understand the A1 system. You guys should understand at this point, you've watched both courses, you've worked through a lot of content, maybe you're watching my live streams. So you should understand that the 3 basic entries that we're looking at with the A1 is either a shift candle or a 2 candle and 3 candle formation. Now you see here at the bottom, it could be a 4 candle formation or a 5 candle. We'll talk about that as we get into some of the markups, but generally speaking, it's either that shift, that cross of the 8 and 21 with a strong bar coming off the 21 with that proper RSI value, or it's a 2 candle or a 3 candle formation. Keep in mind, and I've said this throughout the course before, the entry has to come off the 21 EMA with an A1. Write that down if you didn't understand that already. It has to come off the 21, but it has to come off the 21 with proper RSI value. If you don't know what I mean, we're going to go into it in the markups here. But what we're talking about is the TDI. The RSI needs to be, if you're going long, above that market sentiment line, that yellow liquid 50, and above the trend line on the close of the candle that's coming off the 21 EMA. That part of the TDI is what makes what we do at ASFX so powerful. Now let's get into a few of these ideas. This was a trade on GBP USD. You guys should be pretty familiar with my markups. I'm not going to go through and explain my EMAs. You guys should all understand that by now because I know you've seen the courses. So here, this was a trade. You probably saw it live with us because we were live streaming on this day. And here, this 2 candle formation ends up tanking. Full ADR, 6.6R. It's a beautiful rip. I don't want to say it's a beautiful trade, and here's why. When you see the setup presenting, this is what we had at that point in the morning, right before this thing fell. You can actually see right here where my yellow arrow is pointing, this 2 candle formation is not off the 21 EMA. This is one of many examples I'm going to use today to show you how binary you need to make this decision. It is either a yes or no answer. Is the body of the candle touching the 21 EMA? Right here. Take a picture of this if you need to remember this. And also just keep in mind, the next candle could pull the EMAs lower and maybe convince you a little bit that it does look off the 21 EMA. But even here in that blue box where my red little cursor is, you can see barely, not even, is the corner of the body touching the red 21 EMA. This is what I mean when I say it has to be off the 21. In hindsight, it is not even off the 21, but it can convince you that it is. Here, if you look at the formation earlier, that's off the 21 EMA. This is not off the 21 EMA. And even with that full move, if you go back on the chart, even with that full move, you have to be okay with letting that go because this is the difference between proper entry signals and improper entry signals. And as we go through some of the other markups today, you're going to see how some of these candle formations will do exactly what this does. Paint like it's almost off the 21, but not perfect, and it'll end up reversing. And here you have this bullish divergence in your way too, which is another reason to say, hey, this isn't worth the risk. And that's why I want you to be very precise in the candle formations that you trade. This is another example here on Euro AUD. This happened very recently. This was last week on the 23rd. You can see market sentiment is beautiful for shorts. The EMAs are not that great, but if you look, we're underneath Monday's low. This candle formation, however, was not off the 21 EMA. And what happened? Next candle comes against you and it ends up coming up to your stop loss and tagging you out before it ends up moving lower. So this is a great example of where if you leaned into a trade and it wasn't a proper candle formation because the body is not on the red 21, you could get burned. And that's what I want to help you guys avoid, is getting burned on setups that are not technically ASFX entries. Is everybody with me so far? Give me a yes in the chat if you're following me. Good, beautiful. I love this Zoom thing. It's so fast. You guys, there's no lag at all. So let's talk about some of the knocks against the trades. I've got 4 things here. These are the things that are going to decrease the quality of the setup, meaning it's going to go from an A to a B to a C. And normally with the C setups, we're not taking those trades. I think one of the most important things you have to remember that really makes us unique from all the other Forex strategies that I've seen is that we have language not only to identify winning trades, but we have language to identify less probable trades that we should not be involved in. And that saves us money. I was speaking to somebody recently who does not trade with us, but he knows my business. And I was saying to him, I've been helping a lot of people on the live stream save money by not taking so many entries. People are not falling for the little trap moves. Maybe it's not a proper candle formation. Maybe it's not a good D1 because of something else, whatever. I've been helping people save money. And I was explaining to him that not losing, meaning you're not taking low probability trades and losing money, is almost as good as making money, right? Wouldn't everybody agree with me there? So these are the knocks, like I said, that are going to go against our setup. The first thing, most important thing I want you to keep an eye out for going forward is divergence against the direction that you're trading. So if you're looking to go long, that would be bearish divergence where your RSI is falling and price action is rising. If you're going short, that would be bullish divergence against you where your RSI is rising on the bottom and price action is falling. When there's that disagreement, that's what we call divergence. And it's important, even if you look back at last week, there was a lot of trade setups with divergence. You're going to see some of them in today's presentation that only move to that divergence line and then end up bouncing off of it. So it's important to draw the lines, extend them out, and measure risk reward if you have a potential trade setup to that line. Don't anticipate it to break through a divergence line. They're very significant trend lines. They're probably the only diagonal lines that I will draw, really, because everything else that I like to use is horizontal levels. That's where I found the most consistency. Another knock is not enough room to move to ADR, which means if we have a 50 pip ADR, but it's already moved 45 pips today, there's only 5 pips left. There's no way that we're going to make money in that because we have to assume it's going to be an average day. We can't assume that it's going to go 70. Even if the day before it maxes out ADR, that doesn't mean the next day it's going to do the same thing. It can if it's catching some volatility based on some news or something like that, but that does not happen more often than it doesn't. Does that make sense? Another knock against the trade is going to be these horizontal zones. We're going to talk about them today. I'm going to show you how I draw them so you can really feel solid about the way that you do it going forward. We're going to use that 2 candle rule. The horizontal zones are huge. I think that we have to be logical about this. The people that think price is going to come to one line, when they draw a Fibonacci extension, they think it's going to go to the 61.8 and exactly stop there and come. It's never going to be like that. Price does not just respect one price. Volume is respecting zones. That's why that volume indicator that you guys have seen me testing maybe lately, that's so interesting to me because I know that price doesn't move to just one number. It's a zone where orders are. So you have to use horizontal zones to understand where key support and resistance levels are. And then of course, the most important thing other than the divergence, in my opinion, is that swapping market sentiment line. That's swapping yellow liquid 50. If it goes from the buy zone into the sell zone, instantly that has to go from an A to a B setup. If it's got divergence against it and it's a swapping setup, that's instantly a C setup and it's going to be a lower probability trade. Could you still make money in lower probability trades? Absolutely. I'm going to show you C setups in today's presentation that still move for you, but I'm also going to show you the C setups that don't work out for you that'll hopefully help drive home the point to avoid them completely. Because logically, again, I'm not a statistician. You guys know I dropped out of college. I think, however, that if we were to look at all the C setups that present for the ASFX systems, you either have to take all of them in order to statistically end up possibly on the right side of it, profitable versus not, versus avoiding all of them. You can't try to pick and choose which C setups are going to be winners. It's very tough. We don't have a system for doing that as of me filming this video. So until we do, I think it almost just makes logical statistical sense to avoid the C setups completely, because how do you know which ones are winners versus which ones are losers? And no one likes to lose, right? Let's all be honest about that. So higher time frame analysis is something I want to talk just quickly about. We know that once we find a 15-minute setup that we like, we're going to then move to the 1 hour, the 4 hour, and the daily. Those are the 3 timeframes that we're going to look at. And it's really important that you simplify your higher time frame analysis. As you can see, the focus is only going to be on the 8 and 21 EMAs and the market sentiment line, the L50. There's only 3 timeframes, like I said, that we're going to look at, because then if 2 agree and 1 disagrees, you can lean in the direction of the 2. If you look at 4 higher timeframes, you could be split 2 and 2, and that doesn't get you anywhere. You're still stuck in the same position probably. So now this is an example on GBP JPY just from recently. You can see on the 1 hour chart here, you see the 60 up here. That's how you know you're on the 1 hour chart. For the last 2 days, the 17th and the 18th, market sentiment has been bearish in the sell zone, right? So if you were trading on the 18th with market sentiment in the sell zone and price underneath the 21 near the 8 EMA and the 8 underneath the 21, market sentiment and the EMAs are both short biased here. You notice there's no 50, 200, or 800. I want you to even turn them off right now if you have to. All you got to do is double click on the EMAs and uncheck the other ones, and then they'll disappear for a second, so you don't need to be distracted by them. But over time, your eyes will get more adjusted to where you don't even need to turn them off. But for the example, I wanted it to be clear. So here you can see 2 days of drop. So again, when it extends lower here on the 17th, that feeds the bias for the next day. Look here on the 4 hour chart. You can see 240 up here. This is the 4 hour chart. Market sentiment has been bearish since the 10th. Price action was a little sideways, but the day before the 18th, on the 17th, it starts to finally break out to the downside. 8 underneath the 21, market sentiment's bearish, short biased. Very, very simple. And then the daily, you can see up until 2 days ago, up until the 17th, everything here was bullish. And even here on market sentiment, this is bullish, but these last 2 days are bearish. So now this is one of those examples where the daily is more bullish than bearish because of the market sentiment line and previous price action. However, the last 2 days are clearly bearish. And if you were trading on the 18th, the 17th broke the 8 and 21 and actually crossed price action to be bearish. So that here on the daily aligns with the 4 hour and the 1 hour, feeding the short bias. So if you were on the 15-minute looking for shorts, it would make sense. That's how simple I'm keeping the higher time frame analysis. So now let's just talk about a few tips for entry on the ASFX A1 system. First, I want you to try your best. I know it's enticing sometimes because there can be winners, but there's more losers, in my opinion, with overextended candles than winners. Overextended candles are defined as the biggest body of the day. Simple, not the pin, biggest body of the day. Avoid those entries, in my opinion, unless you take them maybe with a smaller position. You'll see some of these examples, they don't work out. And if they start to pull back against you, it's better to get out and maybe find a better entry with better risk reward. Find a D1 or something later in the day. Don't try to catch momentum on an overextended bar. It's not like stocks where if it rips, it might rip higher. A lot of the time, Forex pulls back. The second tip is that all A1 entries should happen on the close of the 15-minute candle. The 5-minute is not tested yet as of filming this video, and the 1 minute doesn't serve any purpose other than to look at market sentiment. So the 15-minute and the 1 hour are really the 2 timeframes that we have the most testing on the A1 entry for. So only enter on the hour closes if you're trading on the hourly candles, or on the 15-minute closes if you're trading on the 15-minute time frame. Don't enter mid candle because you'll get stuck in a pin potentially, and you'll be like, this isn't even an entry. Now I'm stuck in a trade. And that's the worst position to be in. So don't enter mid candle. Big, big thing. And again, I've said this 5 times already, but I got to drive it home. The candle body has to be off the 21 EMA, not a pin. It can be coming through the 21. It can be coming off the 50 and the 21, but the body, the open price of the candle has to be on the 21 EMA. Simple. So let's go over some examples. Everybody ready for some charts? Follow me so far? Good. All right, so we're looking back to May 14th. This is GBP USD at 6:45 in the morning. This is a really good example of what a proper candle formation should do. The first thing we look at always is the TDI. You can see market sentiment is bullish basically all day. It starts the day in reset right at the 50 value here at the changeover of day, but most of the day it's clearly bullish. The 800 EMA on the bottom is bullish as well. Price action overnight breaks through the Asia high, breaks above the white 200 EMA, and starts to use that Asia high as support. So now that we have broken above that horizontal zone here at the Asia high, and we've confirmed it as support once, twice, 3 times, multiple pins here. When we get this A1 formation that comes through the 21, through the 8, and through the 200 EMA, we know that that's a proper signal if it's confirmed with good RSI value. As you can see, this one is. And what we expect the next formation or next candle to do with these formation is this bar here to continue in the direction that we're looking to trade. With 2 candle and 3 candle formations, it's really important to remember that the next bar should continue in the direction that you are looking to trade. If this bar was to be bearish, that's a bad sign for an A1 candle formation, because what we're seeing here with these candle formations, and really what we're doing with the TDI, waiting for this proper RSI value, is we're waiting for the end of the pullback here to the original move up so we can continue this uptrend. So you really want to make sure you're catching that breakout, and it shouldn't take any time to start moving in your direction. And if it does, it's normally wrong. The other thing that you want to keep in mind with this is that horizontal level, just so I can explain, is drawn because the 2 candles to the left of this pin and the 2 candles to the right are not higher. So you draw the zone using that pin. I'm going to go over that over and over again today. But other than that, once that next bar stays bullish, you expect this to hold the EMA and continue. It rises 42 pips. Is that what that is up there? So about 3.7 R. Not a bad trade. Definitely not a bad trade. Let's go over another one here. This is GCAD on May 6th at 6:15. This was actually a trade that I was in before news. So of course you can read my notes, but first look at market sentiment. It's very bearish today. It was bearish the day before. Everything made sense for me to be looking for shorts today. Look at the EMAs. Look at how we're under the low from Tuesday and Wednesday. Again, I like horizontal levels. We broke under that overnight, tested it once, and we moved lower. We test the low again with a lower high. Of course, I'm going to anticipate that we're going to continue in that trend with the proper RSI value and the right leg of that candle formation coming off the 21 right there. That qualified this to me as a 4 candle formation. And I would expect the next bar to stay bearish as it does. And I was trying to catch a move down into news. Now, as you can see, it wicks down. It actually hit my take profit, and then it came all the way back up. And I think I got out of this. I'll show you on the 1 minute. My full out was at 1.7007. So you can see where I took the position. This blue box here on the 1 minute is this 15-minute blue box right here. So here, look at how market sentiment. This is what I want you to see with A1 entries on the 1 minute. Market sentiment will move in the zone that you're trading. If you're selling it, it will move down and it will hold the sell zone. Here, look at how it continues to make lower highs, price on price, and the market sentiment line moves lower. So I was closing this, as you can see, 20%, 20%, 20% right before news. News hits, I get taken out there, and then I close the full thing as it started to turn around when that news came in. And notice, where does this thing finish the day? Lower. A lot of people actually got short here as the RSI came back down through closer to 9 o'clock. So there was multiple opportunities here, and this is why I love perfect market sentiment lines, because normally they move in that direction by the end of the day. Let's continue. GCAD. This is a little bit more recent. This is June 17th at 7:45. This is one of those formations that can be a little tricky. First thing we have to look at is the market sentiment line. You can see sell zone swaps into buy zone during the Asian session. So naturally, it moves up here at the start of the London session. So because market sentiment is in the buy zone and it already moved up today, and the EMAs are in an uptrend, you would think that you could find long entries today, but don't disregard the swapping liquid 50. That's the first big knock against this thing. The second thing, most important here, is that the right leg of this formation is not off the 21 EMA. It's just a pin. And what does it do? In 15 minutes, it turns around and stops you out. It's just not a necessary trade to be in. It's not a proper A1 entry. Read my notes. Technically, it's not an A1 because it's not off the 21. I think you guys are starting to get that now. GCAD, back to May. I want to show you another one. This is a huge 3 candle formation. It's a ugly TDI, and the EMAs could be better. At most, this thing moves 1.1 R, which to me is a not worth it trade. I'm not looking for 1 R with our ASFX systems. We should be looking for 2 R at minimum when we're taking these trades, when we're looking for risk reward. So here, you have a huge stop loss because this bar is almost identical to the biggest bar of the day. So it's nearly overextended. And on top of that, what's more of an issue is this market sentiment line from buy zone down into the sell zone, holds the sell zone for a few hours, and then pulls back into the buy zone. So there's 2 knocks. It's got a big stop loss, which we don't love. You have this swapping market sentiment line, and you can see I have bearish divergence drawn. So to me, this is one of those trades. You can see it. It's happening. Cool. It could be way better. Your 200 EMA could be above the 800 EMA. If it moves up, you got to just be okay with letting it go. You're doing a good job at reading the market, but that doesn't mean it's a trade you should be in. I'll say that again. Everyone here, if you've watched this far into the courses, can do a good job, or maybe even a great job at reading the market. But that doesn't mean you should be taking a trade every time you think you've got a good read. Take that in for a second. Okay, so now this is going to be one of those winners. This was an overextended candle on a Friday, I believe. No, a Thursday of last week, I think. Either way, the day of the week doesn't matter here. I have it as a C setup. Market sentiment is bullish all day. It's dropping towards reset, but it's bullish. This is a 2 candle formation because it already shifted back here. The 8 crossed above the 21. Another rule with the A1 to keep in mind is you can only have 2 candle formations like this after it's already shifted. You can't have a 2 candle formation to go buy it when the 8 is under the 21. That doesn't make sense. It has to have the 8 above the 21 first. So first thing you can see, it is the overextended bar. So that turned me off from taking the trade. On top of that, you have bearish divergence on top from the RSI falling with price rising overnight. It broke the divergence with this overextended bar, but that still could have been a pop and it easily could have come down lower. You'll see some of those later. Another thing that I knocked this trade is that it's the first break of the Asian range. This black line here is the Asian range. Normally, after we break the Asian range once, we'll either retest it or come down back into the range and retest it before the move out. Normally, sometimes it does this, you can see. But to me, I'm always going to go where the probabilities lie. And the other thing that I didn't love about this is that it is technically counter trend. If it wasn't overextended and the divergence wasn't there, I could have justified it. And if it wasn't out of the Asian range, but those are just things that I don't like. I wouldn't want to trade with divergence in the Asian range. And again, just because it breaks with one bar does not mean it won't come back down and retest that divergence line. So it could have just been a higher probability setup for sure. Here, same day, same time, that was Euro JPY. This is CAD JPY. This one, in my opinion, is a little bit better of a trade. Your divergence isn't as serious because it's smaller. The zone that divergence creates at yesterday's high, you can see it, it's in this orange box. That's the only thing that I really didn't like about this. I like that market sentiment here is above the 50. It's not as close as Euro JPY was. But again here, this is in the Asian range. This next bar is what breaks out of the Asian range and past yesterday's high. And look at, I love how it retests that high and then moves to the 800, really clean, holding the 8 EMA. This actually carried for 2 days. This was a better setup to me. And if you read the notes, it's a B or a C setup. I don't trade with divergence and when it's in the Asian range. If this had just broken out of the Asian range a couple of pips higher, it would have been justifiable to take the position. Either way, if you trade C setups or you trade these kind of B setups, the next bar works really well for you, confirming that it should make its way to the 800. You just got to be patient. It presents at 9 o'clock. You don't hit your target at 3R, almost 4R, until 12 o'clock. So it takes a few hours. Don't just see these black candles here in the markup and think it moves fast. It's not fast. It takes a couple of hours. So you got to hold the trade. You got to be willing to deal with a retest here because you know this is the first break of the Asian range too. So be willing to deal with that retest as well. But this was a better setup compared to Euro JPY, in my opinion, because you don't have that overextended bar. You know what I mean? Okay, so let's see if we have any questions about the A1. I see Riley has sent me some already. Do you weigh knocks differently? Divergence is a bigger knock than being in the Asian range? Good question. So divergence is a big knock. Being in the Asian range is a big knock. Overbought and oversold are more of those small knocks that aren't as serious, or a small swapping liquid 50, like you saw on one of those examples where it's very, very small, like not even 15 minutes, 30 minutes most. That one won't be as serious to me either. But basically every other knock is the same. Yeah. Do you still respect ADR on the 1 hour or just the 15-minute? Great question as well. These are good questions, guys. No, ADR on the 1 hour is a little bit less important to me because I'm looking to hold that trade for multiple days when I take those trades. So I don't think you should be worried about if it's going to slow down today. You might have an entry formation and it might just be slow into tomorrow and then it continues. So I wouldn't worry about ADR as much. That's just from my experience. If the next candle after the A1 entry doesn't close in your direction, would you immediately get out or wait for another candle? So I close half the trade. If I take a 15-minute formation, let's say I enter at 8 o'clock, it's off the 21, it looks good, but the next bar comes down maybe halfway, still outside the 8 EMA. So I still want to be in the trade, but I will close half the trade. And if it's right and it still holds the 8 and continues up, I'll be able to still make money and cover the half that I just closed. If the next bar after that, if it goes 30 minutes, not in my direction, I normally get out of the whole thing. Something's probably wrong. They normally won't do that, especially if it breaks back down through the 8 EMA. It doesn't normally do that very quickly after. You're trying to catch a breakout. You should be in profit within 15 to 30 minutes with an A1 formation. D1 might take a little longer. We'll talk about that in a second. Would you ever do A or B setups making 3 knocks still a setup? No, if it's 3 knocks, it's got to be a best of B setup. But the 3 knocks maybe is like a small swapping liquid 50, overbought, and a little divergence. So the divergence is the main knock. The other ones are a little smaller, and I would still trade that as a B, maybe a C setup. But no, if it's got 3 things or more wrong with it, it cannot be an A. And normally I'm pushing that to a C. Let's say you enter an A1 and later you get another A1. Do you stack or do you just stay confident? Great question. I don't stack. I know some people that do. I normally would then use that new A1 as a place to potentially move my stop loss. Now that does not happen too often because you need 2 proper candle formations off the 21 or 50 and 21 with proper TDI value. 2 in one day is not normal. But if it does happen, I would just bump my stop up in profit to that new stop loss level of that second A1 formation. I hope that that makes sense. Good question. Are horizontal boxes only based on divergence or sometimes combined with previous day high and low? Good question, Scott. So when we draw the horizontal zones, I use the divergence high or low, and I find the pin where the 2 candles to the left and the 2 candles to the right are not lower or higher, and I'll draw the zone there. So it's like the divergence structure zone. You'll see that in the D1 examples. But also I will use yesterday's high, yesterday's low as boxes as well. But you also saw sometimes I draw a line and I just draw the line on the body. And I know if it's near that zone or under that zone, then it might be broken. You know what I mean? So I think the box is always the way to go though. Yesterday's high, yesterday's low are definitely important. All right, last question for now. If the body is very close to the 21, will you take it as a knock? No, Andrew, if it is not on the 21, it's not an A1 entry. It could still move. It's an engulfing formation. It can still move. But if it's not off the 21 with proper RSI value, it is not an A1 entry. So normally you don't take those. Then you're breaking the edge. Does that make sense? Okay, we'll come back to more questions later. I want to move into the D1 now. How are we doing on time? Nice, 30 minutes. Cool. So let's talk about the D1. We're talking about these divergence trades that are created at significant levels. We're talking about using the 15-minute and the 1 minute for entry, 15-minute for identifying the trend, 1 minute for the entry. Now, as we've developed the D1 further than when I first built the D1 course, we're focused less on how many jabs to the divergence line there is, with more focus instead on the price structure that's created after the divergence has already stopped either falling or rising. So we're looking at price structure more than jabs. Very rarely, this is the big change, very rarely am I entering on the first break of the 50 EMA after we've got 3 touches to divergence. I'm not even counting the touches to divergence. I'm looking for that first break of the 50 to then have a retest and give me structure showing me we're moving in the opposite direction than what price was doing. So I know that I have a better stop loss than if I was to just take the first break of the 50 EMA, because in some sense, if you take that first break of the 50 EMA, when there's divergence, let's say it's bullish and you're trying to buy it, when that bullish divergence sets in, first break of the 50, it could come down and still give another test of that divergence. But if you wait, I'm going to show you how to do this. If you wait, you're going to find better entries, tighter risk reward, and you're going to feel more confident in the trade. That first break of the 50 EMA is not always the best entry, but there are some that you can do that and they'll still work. You've seen those in the rest of the course. You'll see me still do that. But the structure on the 1 minute will keep you safer, more confident, and with tighter risk. So like I said, the first thing for the new entry rules, we're going to really focus on high probability trades. We're only going to trade, in my opinion, if you're trying to be picky, we're only going to trade long when we're already in a 15-minute upshift. And we're only going to trade short when we're in a 15-minute downshift. The shift is the cross of the 8 and the 21 EMAs. So if we see a D1 setup under the 50 EMA, the 8 and the 21 are crossed down, but we want to buy it because 15-minute market sentiment says to buy it, I won't necessarily take that D1, especially if there's other knocks on the 15-minute setup. I won't take that as a D1 anymore. I'll wait for it to shift into an A1. I'll either trade the shift candle or I'll trade a pullback as a 2-candle formation or something like that. But I normally am now waiting for the shift on the 15-minute to move into my direction, and then I'm looking to trade. Now, you can still have that D1 setup. It can throw a shift, cross the 8 and the 21, pull back on the 1 minute, and you can still trade that as a D1 after the A1 shift candle. But that keeps you on the right side of the short-term trend rather than forecasting that upshift. I'm going to give you some examples of this. You're going to see it many times now, but I just want to put this to words first. I want you to use the 8 EMA especially as the barrier to know if you should stay in the trade. If you are trading long from a downshift, meaning you're predicting the upshift, your entry from my markups, your entry should not turn down and break the 8 EMA. If it does, I would pull the whole thing right there because you're forecasting some type of upshift when now it's coming down through the 8 saying, no, that downtrend that it's actually in already is going to hold. You tried to forecast, you didn't react, and now it's turned against you. And that's how you can get out. It should not break the 8 EMA. However, if it gets into an upshift and then it breaks the 8 with one candle, that's okay. You're in an upshift. Let it hold the 21 still and let that trend continue. And this is a very important piece here. The 1 minute liquid 50 is very, very accurate. This should stay in the zone that you are trading, meaning if you are buying the 1 minute liquid 50, 1 minute yellow market sentiment on the TDI should stay in the buy zone. And if you're selling, it should stay in the sell zone. It's very simple, super easy. Don't overthink it. It's a lot better than watching price action on the 1 minute. So I'm not even watching 1 minute price action after I take my D1 entries. I'm only watching the 1 minute liquid 50 and to see if the 15-minute candles close under the 8 EMA. That's all I'm paying attention to. So let's talk about this trade on Euro NZD. This happened just a few weeks ago. This was right before our Miami seminar. So some of the guys that are here that were at the Miami seminar, you might remember this trade. You've got really good market sentiment. It swaps to start the day very briefly. About 30 minutes, 45 minutes, then it's in the buy zone all day with price making higher lows, higher highs. Structure looks great. Here, this is one of those situations where it does shift down. The 8 crosses under the 21, but it is still holding the 50. It's still making higher lows. It's still holding the 200. So you could say it's still in an uptrend. Monday's high is in your way. The high a day is right there. So it's already shown some rejection to that. The risk reward to that level is not that great. So I'm not saying this is a trade that I would want to be in. You see the knocks against it, the swapping liquid 50, the resistance in that way. But if you go to the 1 minute here, because you're looking at the overall trend, you're trading in the direction of the market sentiment line, you can see what I'm talking about. So now the divergence is set in back here on the 1 minute. That gives us our bottom. We really don't retest that bottom. This is very brief, so I wouldn't really consider that. I normally like to see it come up and then back down. So instead of just jumping in here when it breaks the 50 EMA the first time, if you do that, you will get burned on some trades because what is this doing? It's making lower lows and lower highs. Even at that point, this could be a lower high from here and it could come back down. So instead of getting in there on that first break of the 50, see if it can hold this bottom as it does here where it really does set the higher low, and then see if it can pull back through the 50 once the market sentiment line is in the zone that you want to trade. That's the safe entry because then I can use this higher low right here as my stop loss, that tighter level as my stop loss. Even if you want to give it more space, this is only 6 pips of a difference. You could put it down here. That's fine. I do that sometimes as well. When they're close like that, I'll just put it at the divergence low because I know it should not break that level. Sometimes maybe it does come back and retest this a little bit. So to me, using the divergence low could actually be just a little bit more conservative, you know what I mean, to give it more space. Either way, once you take the position on that break of the 50 after the higher low is in, market sentiment should hold the buy zone, just as this one does. That will tell you the direction of the move. Okay, we're going to go through this so you can see it more and more. So this was a D2 idea. I want to come back to this a little bit later. It's got some D1 in it, but I want to move through some more specific D1s. So this is one of those setups that I was just explaining about trading long in the downshift and watching it hold the 8 EMA. So here, this was Euro GBP AUD. After being bullish on this for multiple days, we had a range that we were trading in between. You can see the Monday high zone is tested here at the start of the London session. As it moves from London into New York, it actually comes back down to this blue zone here, which was Monday's low. So it was trading in between this range. Notice I have a lot of knocks against this in my notes. But if you keep that long bias that was there overnight, that was there because of the market sentiment, and you like to buy it off this significant level, you could easily come in and find a D1 entry. Now, it's still a D1, even though you're in a 15-minute downshift. And remember what I said at the start of this section. The bars should break the 8 and stay above if you're buying in a downshift. What does this do? Just look at the yellow 8 EMA. It never closes below, and it runs right back up to that high, full ADR reversal to that Monday's high zone. Exactly where you'd expect it to go when it's in a range. Now, it's a tougher trade to take, don't get me wrong. Market sentiment's in the sell zone at the time of the entry. You're, again, going against all the EMAs, but just notice how powerful the 8 EMA is there. And if you look at the 1 minute, you get that safe entry that I'm talking about. So here's your divergence, 730 to 745. We make a higher low, a higher low. We're now making higher highs. We broke past this previous high. So now we're making higher highs and higher lows. As it comes back through the 50 here, again, if that stop is very close, I'm not going to put it that tight. So you can see I bumped it down to the most recent higher low, which is right here, not the bottom, the most recent one right here. Because if it breaks that level, it's moving down still. So we would want to be out of it. But if it holds the market sentiment in the buy zone, look at how it does for hours, for 3 hours, it'll continue to move up. And that's exactly what this did. It broke the 50, moved up to the 1 minute 800, which is the 15-minute 50, naturally found some support there. But look at how well it respected horizontal levels. It broke, used it as support, broke, used it as support as it continued higher. And this was the full move. Used it as support and then continued up into the rest of the day. Market sentiment, this is important here, held the buy zone till 12:30, from 8:30 to 12:30. Like I said, 4 hours of market sentiment in the buy zone saying, stay in the position, take profit at R multiples, stay in the position, take profit at R multiples. So even on an uglier setup, if you understand how to use the D1 and wait for that safety entry, you can trade off this significant level. This blue zone here comes from the previous week's support. It's a very significant level. You don't need to just do D1s off EMAs. This is a more advanced trade, but I wanted you to see the structure on the 1 minute, how well it held. And then this is the move into the next day. It ends up it gets pushed up by news. Euro JPY, I've got another one here. So this is another one of these D1s that's in a downshift. And this is typically what it will do. This is like a typical D1 downshift into buying it where it goes. Normally, well, what I mean by that is normally it will not break for a new high of day. If you're trading underneath the 50, normally it'll pop the 50 or reject the 50 and then finish the day sideways or lower. So that's exactly what you see here. It doesn't go for a new high a day, but it does give you a pop. Notice market sentiment is bullish, but you have bearish divergence in play. This presents itself on the 1 minute off the 800 EMA and 200 EMA. Significant support for sure. What does it do every candle after the entry? Up to the 2R. It holds the 8 EMA. So you're making money on this trade, not a ton of money. It's a low probability setup just because you're buying in a downshift. But other than that, market sentiment is bullish. You don't expect it to go to the divergence line. So you're just looking for 2R maybe, and you're able to get it here. Look at this 1 minute setup. Beautiful divergence from 6:15 to 8:15. And again, since we started this presentation, have I counted the jabs at all? Not once, because I'm looking for structure. Once I find the divergence bottom, I want to retest. What do I get right here? A beautiful higher low. Now we're continuing, as you can see here, we broke past this previous level. We're continuing to make higher highs, higher lows. We get above the 50. As soon as market sentiment is in the buy zone and we're either breaking or retesting that 50 and I can identify a support level, the bottom here, the higher low, that's where I know my risk is, then I'm comfortable to take the trade because I know I don't want it to turn down there. And what does market sentiment do here, everybody? Holds that buy zone. Beautiful, right? And that's where you get that rip right up to the 20 pips. Boom, 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 real quick. 9 o'clock to 10:15, you're up over 2R, stop loss locked, and you're good to go. So now let's move into some of the lower probability setups. You guys can keep the questions coming, and we'll come back to those at the end. This was a very recent trade. Now you saw some of these, we'll call them counter 15-minute shift D1 entries. Here, you could have tried to short Euro JPY, this was last week, because of this market sentiment line. You could have tried to short it. It's at the ADR level, it maxed out ADR, it's near its high a day. You could definitely think, all right, this is gonna reverse. But what's it doing on the short term? It's in an upshift. 8 EMA is above the 21, market sentiment is rising. So if you try to short this, you're going counter trend. And this is what I'm saying, it's not worth it because here that 8 and 21 shift holds and it actually comes higher. And if you look on the 1 minute, you get the structure that I'm saying we want. You have the divergence, lower high, breaks the 50. Another lower high, breaks the 50, now with market sentiment in the sell zone. When it breaks the 50 right here and here, market sentiment is in the buy zone. Right here, it's in the sell zone, and now you feel more confident to use this as your stop, right? What does it do? It pulls the market sentiment line back up into the buy zone here, and that's when the trade turns around and comes against you and comes towards the stop loss. Do you see that? Once the market sentiment goes from sell zone, it's telling you it's struggling, price isn't moving, market sentiment starts rising, you know you're going counter the 15-minute shift, now's when you get out. Market sentiment's coming against you, you get out. Take the quick little loss, break even, and ask yourself, why did I try to go short into an upshift? This could hold the 21 and keep rising. Following me? Here, this is another one of those setups. There's a lot here. First thing that you'll see, market sentiment is perfect. That's why we're looking for bullish moves here. I remember this day, GBP AUD just tanked. Notice how it shifted down though. It does shift down here. So you're trading long into a downshift. 8 EMA is under the red 21. That's in a downshift. So here you get the D1 set up on the 1 minute, but you're trading not only into divergence, but also into this horizontal zone that's clearly resistance already. So you're not above the resistance trading with it as support, you're trading into it. So not only are you trading in a downshift, but you're trading into divergence, into the zone. And now, if you look at the 1 minute, where I think I took this trade, I'm pretty sure I did, where I took the position here, my market sentiment line was in the sell zone, and I ended up losing this trade. And I look what I wrote, could have closed them here when it shifted down on the 15 minute. Once the 1 minute liquid 50 gets into the sell zone, it's B. What happens? 1 minute liquid 50 gets into the sell zone. It's already at my stop loss. I should have closed some, as you can see right here in that next bar, right after the 630 bar shifted this thing down, because I thought it was going to shift up. I tried to forecast that shift up, and it ended up coming down, and I ignored it. Some of you guys might remember this trade because this was on stream. So that's what I'm saying. Waiting for the proper shift, you won't get caught in moves like this. If this was in an upshift already, it's much more justifiable. Here's another one, GBP CHF. You've got bullish divergence here on the bottom. You see the low. It hits that low and can't get lower. So it's actually rising off that, kind of like a D2. In that move of the D2, you don't know, is it going to the 200 or going up to the 800 for full reset? Here, if you tried to short it off the 800 because market sentiment was kind of bearish, it's in the buy zone now, so it's definitely not a great market sentiment line. But let's say you tried to short that, it doesn't work for you. Even if you wait for the 50 retest, see how it sets the divergence, retests here, and that's when market sentiment is in the sell zone. You can tell that's what I'm waiting for, 50 retests with market sentiment. Here still, market sentiment comes into the buy zone. You could have gotten out here well before your stop loss. Well before your stop. So just paying attention to 1 minute market sentiment with your D1 entries and waiting to get in until the market sentiment line is in your zone is the way to go. This one isn't a winner. It goes about 1.9 R, but again, trading in the downshift, what did I say? Normally it doesn't go for a new high of day. This does not go for a new high of day. Notice your 8 is under the 21 at entry. Market sentiment is bullish, but I knocked the fact that it already maxed out ADR, so I'm only trading up to ADR, which was just about 2R. I knocked the fact that it's overbought, and like I said, it's in the downshift. Not a terrible setup, definitely not. It's rising for sure, but I would have rather it be in an upshift, and this is what it looked like on the 1 minute. Here, divergence sets in, higher low, higher low, multiple breaks of the 50. You can see how important the 1 minute 50 EMA is. Then it gets above the 50 again here, now with market sentiment in the buy zone. So I'm not just taking the 50 EMA retest if market sentiment is in the sell zone. I just showed you a trade that cost me money that I lost on because I still did that. I think it's so much more profitable, I know it is, to wait for the market sentiment line to get in the zone that you're trading. And what does this do? Even on a low probability setup like this, how I have it knocked with 3 things. It's already maxed out ADR. It's in a downshift. Look at the 15-minute candles holding the 8 EMA. Never breaks the 8. Just like I said, it should if you're trading in that opposite shift. And with that, the 1 minute market sentiment line will hold the zone that you're trading here, trading in the buy zone. Here's a winner, Euro GBP. Overall here, this is short biased. Look at the market sentiment line today. It's clearly short biased. This is a D1 after it already maxed out ADR, coming off the 800 and the 200 EMAs, but it's in an upshift. But look at the bars. They never break back above the 8 EMA. You see that? All day. So if you are trading when it's an opposite shift, if you're selling in an upshift or buying in a downshift, watch the 8 EMA. It should not reverse back against you through the 8 EMA. That's the worst thing that it could do. If you go to the 1 minute here, your divergence sets in. Look at how it pulls market sentiment into the sell zone and then just holds it there for 2 hours here. You get your retest. You have a lower high here, a lower high here, through the 50 with market sentiment in the sell zone. That's the trigger. Stop loss at the divergence high. I didn't want to keep it too tight. I wanted to give it up to that high just because it's not that far. Remember what I said. If it's like 3 or 4 pips of a difference, 5 pips of a difference from the newest lower high to the divergence high, I don't know. It might come back up and do a third test there. So I'd give it the more space because you know if it was to reverse above the divergence high, you would not want it anymore. Okay, so let's move into some higher probability setups. Euro AUD. This was a trade that I was involved in. Swapping liquid 50, can't ignore that. But everything else about this setup was very bullish. Higher timeframes were more long biased than short biased. I waited for the shift candle and I got in at a really great price. So even with the swapping market sentiment line, as you get more advanced, you've gotten all the information from the courses so far. Even as you get more advanced, you can lean into some of these trades if everything else is on your side. I'll trade a swapping liquid 50 if the higher timeframes are in my direction. So here you can see where my entry is marked. The 8 is above the 21 EMA. So it's already in the upshift. Notice how it's holding the 50 EMA here on the 1 minute. You get That 50 EMA on the 15-minute is the 1-minute 800. You have bullish divergence there at that significant level. I drew the zone with this pin right here just to see the hits to it. And notice I don't rush into it. I didn't try to jump in here before the 15-minute shift candle. You can wait for the 15-minute shift and then get in once it shifts up, or you can even hit it here at the 50 EMA using this divergence as your low. So it's a D1 setup, 15-minute shift candle. You can enter on the 1-minute retest here using the most recent higher low as your stop loss if you trade it like a D1. So you can trade it either way. And what this is just the typical pullback after we see a shift. A shift always pulls back. That doesn't mean you're going to lose. You still make money on this. But I think the D1 part of this is very, very powerful. Sets you up. You wait for the upshift. You get in on the 50 EMA retest after the upshift using the divergence structure to identify your stop loss. Make sure you're taking notes on that, everybody. Don't lose me here. I know how deep are we right now? 40 minutes, an hour? Yeah, 48 minutes. Stay with me here. Okay, so this was a trade that I was involved in. I got a great exit on this trade. Market sentiment is very, very bullish today. And I like when it's a perfect market sentiment line in the buy zone like this, trading long to the 800. I would like it if it was in the sell zone trading short, but I like that counter trend move because it gives me a target. I know it can hit the 800. I know it can come off the 800 too, as this does, but I can catch a pop here. So we get higher lows overnight. This high of day zone is this blue box. That's giving us all the resistance today. But once we made a higher low here, this was at 9:15 in the morning, we shift up. So I don't need to D1 it down here under the 50, into the 50, into the 200, into the high of day. I don't need to do that. Let's break the 50. Let's get into a short-term upshift because then I know from doing so many markups on this that it should hold the 8 EMA. And if you do that, this is what the setup looked like. Divergence, bottom, comes back to the 50, holds that 50, gives me the new structure point. I don't need to go all the way down here. I have 3 hits to this level here. I want my stop right here because market sentiment is in the buy zone and it should hold that market sentiment in the buy zone if this move is to go higher. Once the market sentiment line comes back into the sell zone here at 10:45, you're still in profit. So you're either getting stopped out in profit or whatever it is because this move was to the 800. It was 4.4R. I remember I had a really good exit at 157.55, right above the 800 was my best exit. And then I got stopped out in profit on the small piece that I had in as it came back down. I didn't know if it was going to rise through the 800 all day or pin it and come down, but I'm always going to take profit there and at each R multiple along the way. But you can see once that market sentiment line's in the buy zone on the 1 minute, and then we get the structure through the 50, I know where my stop is, and I know I want that zone to hold. This was a trade that James was in. I know a lot of guys made money on this recently. This is GBP NZD on the 18th. Market sentiment is great. The divergence on top gives you a great target because from where we're at the 50 EMA, you have, what is that, 3.8R all the way up to that high. So with that good risk reward, of course, we're going to be interested in buying that today. Notice it holds this zone from where we consolidated at yesterday. I know you can't see it, but this ended up moving higher yesterday. And then this was the zone it set at the end of the day. It held it here, it held it here, it held it here. So I'm clearly going to be buying this up towards that divergence structure, up towards the high of day with a perfect market sentiment line. Now, this is what I'm talking about. It's a D1 down here in the downshift, but you wait for the shift. You can get in on the shift candle alone on the 15-minute as an A1. You know where your stop loss should go. You don't get touched here. Or you can wait for the D1 entry on that retest and then catch the move from there. Notice how this holds the 8 EMA from down here, above the 8, above the 8, above the 8, all the way up here for that first pop. Now, it does get a little choppy at the end of the day, but you are able to get 4R out of this. Go to the next one. You'll see. Here's the divergence. Set in, higher low, confirmed. Higher low, confirmed. Higher low, confirmed. Look at the market sentiment line, holding the buy zone, holding the buy zone. Even here, where the shift candle entry is, there's the pullback to the 50. You could get in here with your stop loss a little bit lower right here because that's your structure. And look what it does. It continues to rise and hold the market sentiment line in the buy zone. Now, even as it dips the market sentiment line here at 8 o'clock, it's just consolidating sideways. So you're not really getting out of this trade because you're giving this time to build. Notice, if you give it that time, it will hold that 15-minute 8 EMA and move in your direction. So that's just another example of how you can go D1 shift candle into D1 entry. Is that making sense? Give me a yes if you're following me. Here's another one. Market sentiment is perfect. You get a shift candle here in blue. You get the entry that I was looking at here off the 8 EMA, and it holds the 8 above the 21 all day. Big rip, 68 pips. But you get multiple entries. A1 shift candle from a D1 into a D1 entry that I took, and then this 4 candle formation on the A1 here. Now it's under Tuesday's high, but that doesn't keep me out of the trade. That's just something you want to pay attention to for your size on the trade. You want to stick with that market sentiment long bias and look at it holding the support here from Monday's high. You see, this is Monday's high zone resistance broken and used as support overnight. This is the zone of support that we're trading off of. If you look at the 1 minute, here's your divergence from 1 to 3 a.m. That's right here, this white line right here on the 15 minute. So there's your divergence. Look at market sentiment, just holding the buy zone from 4 a.m. until 6:30. So I woke up and all I saw was structure, higher lows, touching the 50, and holding the market sentiment in the buy zone. So I took the position at 611 as it comes through the 50. I didn't use this as my stop. I used the most recent higher low prior as the stop, giving it a little bit more space right there. There's the stop. There's the entry. You can see it ends up moving up for me a little bit, pulls back down, and here it pulls the market sentiment line into the sell zone. So you think, okay, do I bail on the trade or do I hold? If you go back to the 15 minute, it's still in an upshift. And I know it can hold that 21 EMA and keep coming up. So I don't bail on it when it does this because I'm paying attention to the 15 minute. And because the 15 minute is still in an upshift, you want to give it time to hold the 21. And look what it does. Not only does it hold the 21 with this blue box, that's the 4 candle formation, it actually gives you bullish divergence in there, which is another confirmation of the long idea. And then from there, market sentiment basically holds the buy zone all day. And that's what brought this thing up all day. So you don't want to just bail. If you're in an upshift, if you're trading with a perfect market sentiment, don't just bail when the 1 minute L50 swaps into the sell zone or buy zone if you're selling it. Don't just bail. Pay attention to the 15-minute shift. You can always shave a little bit of the position off. And then if you do that, you can get back in once this A1 formation presents, because look at that. Body's off the 21, RSI value is proper at the entry, next candle stays bullish. That's an A1 entry right there. So there's multiple layers here, but it's really important to just stay patient and trust the 15-minute. Even though we're using the 1 minute for entry, trust the 15-minute. Okay, here's another one. Market sentiment, very bullish. You get 4R out of this move, almost full ADR. It's a D1 into an A1 shift candle. So you have your divergence down here at the 50. It's holding above the 800. It used the 800 as resistance, then support. See that? It broke above overnight. Now it's support. And we're above yesterday's high marked off here at the body. So we're coming off yesterday's high, coming off the 800 with a perfect market sentiment line. That's very good for longs. Look at the divergence here, 3:30 into 5 o'clock. Then you get your higher low. Again, look at the time here from 5:30 to 6:30. I'm waiting an hour. Here's a higher low. It comes back through the 50, but the market sentiment line is in the sell zone. So wait again. You get another retest under the 50 for another higher low, and then it comes through the 50 here with market sentiment in the buy zone. And that's the point where I would be comfortable to say, okay, if this holds the buy zone, I've got a higher low, I've got 1, 2, 3 higher lows. I know it should hold this level and come higher. And look what it does. Market sentiment just holds the buy zone for 3 hours. So again, if you start to use what we're talking about here, do not ignore the 1 minute market sentiment line. That's probably the biggest takeaway from this. If you're buying and it goes into the sell zone, most of the time that trade is beat. Sometimes it'll work out like that Euro NZD trade I showed you, but most of the time it's beat. So either get out or shave some off. If the market sentiment line holds your zone, don't take the full position out. Piece yourself out at R multiples. Give it time. This was a really good trade. This is Euro USD. You have divergence on top. You see that. You see the zone from Friday's high. We're kind of using that as support here, making what looks like higher lows throughout the day so far, from the Asian session low into the London session and then into the New York session, because this is coming at 11:30. This is late. But that is a swapping market sentiment line. So you got to keep that in mind. If you go to the 1 minute, you'll see the divergence at 8 o'clock. You'll see a higher low tested multiple times. So you'll see that. If that market sentiment line on the 1 minute cannot hold a zone, you're going to see touches of the most recent level. So wait for that market sentiment line to be very clear in the buy zone and for you to be coming off the 50 EMA. You would not want to be buying it in here just because price action is bullish and it's in the buy zone. Don't do that. It's got to come through the 50 EMA. This was having a lot of issues here. Read my notes. You're getting in long when it's in a downshift too on the 15 minute. So that's why I'm not marking my entry back here. I'm marking my entry here because now we're in an upshift. Now we're ready to move higher once we've tested that low more times. Even so, let's say you accidentally get in here. If you use the divergence low as your stop loss, you're not getting tagged out. But I would say wait for the upshift, get in on the retest after the shift candle. See, as we're closer to an upshift on the 15 minute, then you can take the position here with that market sentiment line in the buy zone and look at how it holds. And from that position, this thing ran for 2 days, 97 pips. Overnight, it moved higher, started the London session, it maxed out ADR the next day, and it moved higher overnight the next night as well. So that was all from an 11:30 a.m. New York time entry. You'd think that's when markets are slow and they're not moving. It doesn't move much that next day. You see, it only moves 13 pips. But if you hold the trade and you're confident, stop loss is locked, you can hold that for multiple days because you're coming off the 50 and market sentiment can stay bullish. Okay, this is GBP JPY. It is a swapping market sentiment line, but you can tell it's moving lower. You had an A1 entry here overnight in the Asian range. That's not one that I typically would take. It is off the 21, but being still in the Asian range and having a swapping liquid 50, I'm not going to be doing that. However, you get another A1 formation here. The RSI wasn't that great on that close. It was barely through the market sentiment line. Also, this is your biggest bar of the day so far, as you can see in my notes. So it's a swapping liquid 50 and it's an overextended bar. So I would wait, and waiting actually ends up doing you well. It pulls back to the 8, but it holds the 8. Here's that formation. See the blue box? Here's that formation on the 1 minute. Inside that 15-minute A1 entry, you have a D1 setup with bearish divergence in the formation, a 50 EMA retest after the fact with market sentiment in the sell zone, and it moves lower. So that's your lower high. Another lower high here. Another lower high here as it's holding underneath the 1 minute 200, which is very similar to the 15-minute 8. So it's holding the 8 EMA. And now, again, just looking at it like a D1, your stop goes here at the divergence high because you wouldn't want to put it right here. It's too tight. Put it at the high and trust that if the market sentiment line holds the sell zone, because you're entering when it's in the sell zone, then this will move lower. And it does. A nice rip, 5R. And you're entering off the 8 EMA. And I know that that's frowned upon if you're trading A1, but this is D1. D1 off the 8 EMA is good. It should hold the 8. And if it doesn't, it quickly breaks the 8. You want to be out. It's a great position to be in because if I can get out quick, I minimize my loss. I closed some of this trade here. You can see, look at that market sentiment line from 7:54 through 10 o'clock, almost to 11 o'clock. Okay, let's move into the next section here. These are going to be the trades to avoid. We're going to look at EuroCAD here. These are some recent setups. We've now gone over the D1 a couple of times. I've shown you now that safe entry that I'm looking for. And I think everybody so far, it seems like you guys are following me. We're going to come back to the questions here. I don't have too many new ones, so we'll come back to the questions in a little bit. So here we're looking at EuroCAD. This is last week. Here, we had a really great 15-minute market sentiment line. This 2-candle formation, however, you could get induced by. However, read my notes. The RSI was not through the trend line and the liquid 50 at the time of the close, and it ends up turning around and stopping you out. You do have bearish divergence in the formation. Don't let that sway you to just taking it as an A1. If it's not proper on the 15-minute close, meaning if the RSI is not through, you don't just jump in because you've got divergence. You're not trading D1. You're trading A1. If you're using this as a D1, you're looking for a 50 retest with it coming lower. This isn't coming lower. It instantly turns around and comes up to stop you out. So I kind of told everybody as we were talking about this trade, I was like, this will normally turn up and stop you out. And it's a good lesson. If you take the trade, it is a good lesson because it's not an A1 entry. Now, if you look at this as the day developed, there's the 2-candle formation I just showed you. It comes back up. It actually tries to get you again, a 3-candle formation here, but that RSI was not through. This big next bar is what pulls the RSI through the liquid 50 now to make it look like it was through on the close of this candle, but it was not. You just got to be paying attention in the moment and you'll see that. So it tries to get you in twice on candle formations. Some people will say, Austin, why don't you take it short here? You could have made money. If it's not an A1 entry, it's not a good trade. And here, yes, it falls for 15 minutes, but look what it does the rest of the day. Exactly. And here, just to talk about it, this is a 2-candle formation off the A1 or off the 21. You can see the body is touching the 21. But what does this do? It's overextended. It pulls back almost to your stop loss, probably tagging you out. So just more reinforcement here. There's 3 examples. Screenshot this if you need to of what to avoid. All these trades are trades to avoid. Winners or losers, that don't matter. These are trades to avoid. This is the GN setup that we talked about a few minutes ago. Here was that shift candle we were talking about. Later in the day, it throws this 2-candle or 3-candle formation, but you can't even get 1R to the high a day, to that divergence high. You can't, it's only 0.9R at most. So because the risk reward was screwy and it's a Friday, I didn't take this trade. I'm not trading for 1R. You could trade it and go get 1R. Make sure you lock your stop quick and you're going to deal with some chop. But to me, I'm looking for better trades. It's a good looking market sentiment line, but the move on this was down here. Trying to buy it here at 9:15 after it's already made a decent move. You missed the entry on a Friday. You just eat that and come back on Monday, in my opinion. So this is a 2 candle formation on Euro GBP. It is overextended. It's the biggest bar of the day, so I would pass on it, even with a perfect market sentiment line, even with it coming off yesterday's low. Look, we broke yesterday's low, retested it. Okay, we're using yesterday's low as support to come lower, resistance to come lower, whatever. What does it do with the next bar? Turns against you. If you took the position and you realize that it's overextended, or maybe you knew and you still took it and it was overextended, get out of the trade when the next bar does not work for you. If you're going to try to catch momentum, momentum doesn't turn against you. So if you're trying to trade an overextended candle, you're trading momentum. And if it doesn't go in your direction, I would definitely get out of the trade. Here's another one. 4 candle formation. The bar on the right is coming off the 21 EMA, so it is a valid A1 entry. Not only is it overextended, but it's got a swapping liquid 50. Those are 2 knocks that say no go for me. And what does it do? Turns around and stops you out. So you can see I'm showing you these losers because it's really important. And then to tie it together to the D1 entry, notice from where we took the position on this idea here. When does the market sentiment line get into the buy zone? Right here. It's not stopping you out. It actually comes back down towards your entry. You'll see this often with the market sentiment line against you, and you'll think, oh, it's still moving for me. It's still moving for me. No, it's not. Market sentiment's in the opposite zone. It's coming to your stop loss. This is your best exit. This is how I saved James some money last week on his trade. I said to him, this might be the best time to get out because that market sentiment swapped and it's not coming back. You can't forecast it coming back into the sell zone. Once it goes from sell zone into buy zone, if you're selling it, it's time to get out. Okay, so this is important. EuroCAD was very bullish last week. You can see market sentiment was very bullish. Once it shifts down, however, no divergence on here is powerful enough to send this higher. Not only do you have this bearish divergence on top, you have a huge pin to start the week, which actually maxed out ADR. I didn't turn the lines on because there's just too much on the chart. But once you shift down here, plus you've got the divergence, instantly just take this off the list. Look at how many sets of divergence it builds. But what does it not do? It does not pull the market sentiment line into the buy zone. So some of you guys would have tried to buy this here because it's a perfect market sentiment line at the 50 EMA. But if you apply the new rules I'm sharing with you today, you would not trade it because it's in a downshift, and that could be better. And also you will not get in on any of these 50 breaks because the market sentiment line never gets into the buy zone. And for the safe entry, the market sentiment line needs to get into the buy zone. That's a great example to show you what I'm talking about today, because now I showed you what it is, and this shows you what it's not. So make sure you understand this one. Here, this is an A1 entry. Swapping liquid 50, it's in the buy zone more than it's in the sell zone today. And there were better entries. Look, EA and EN look so much better. Why come and trade GA? When you're about to trade GA, go look at EA. Go look at the other AUD quote pairs and see if there's better signals. Here, it's a 2 candle formation and it falls for 15 minutes, but it doesn't even go 1R because it's a swapping liquid 50. What that swapping yellow market sentiment line is saying is that buyers are in more control than sellers. Euro GBP, this is a good one, very important. Decent looking 2 candle formation. Market sentiment is bullish, higher lows, higher highs. You do have bearish divergence set in by the time you take this entry, so you'd be trading towards that. But the most important thing is look at the RSI. It is not above the market sentiment line when this candle closes. It might look like it is to you, but if you draw your line proper with your vertical line, that RSI is under the yellow market sentiment. So it's not an A1. And then you'll say to me, Austin, there's money to be made here. I got to catch this. This ended up falling lower and actually finishing for a new low a day this day. So to me, this isn't my pips. That's as simple as you need to leave it. If it's not an A1 entry with proper RSI value, we're not just trading 2 candle formations like this. If you traded every little 2 candle formation you saw like this, disregarding the TDI, you'd lose more than you'd win. 100% sure of that. I'm 100% sure of that. Here, another great example. Where's the RSI? Not above the market sentiment line. That is not an A1 formation. Next candle tells you that it's bad. But if you held because you're ignorant, it stops you out, and then news pushes it up and slaps you in the face. How many of us have been in that position where you take a position, you fudged an entry, you get stopped, and then it moves in the direction that you thought it would? That's just the market teaching you a lesson. It's not a good entry. There was no good A1 here. You just let the move happen. You come back the next day and you look for longs. Market sentiment stayed bullish. You come back the next day and you do it. You don't trade news. You don't trade trying to catch the volatility of the news here at 9 o'clock or 9:30, whatever it was. And you don't trade an improper formation. Here, more improper formations. Twice this one tries to get you on Euro GBP. The market will try to get you. Market sentiment is very bearish here. You can see that. RSI not through on this candle formation off the 21. RSI not through on this candle off the 21. And both of them give you a chance to get out before getting stopped. If you would have went short here, this bar 30 minutes later would stop you out. But 15 minutes later, you can get out for a 3 pip loss. Here, you can cut this 10 pip stop in half and get out at a 4 or 5 pip loss if you're aggressive. Don't enter when the RSI is above market sentiment line. It's got to be through. It's got to be underneath if you're shorting it. This is another example, GBP NZD on that same day from the GA I showed you. Look here, before the news that kicks it higher, this 2 candle formation could induce you, but the RSI is so far from the market sentiment line. So even though it's got a perfect market sentiment line, doesn't matter. If the RSI is not through, it's not a 1. This was a trade that James was in. I remember we were talking about this. Look at the zone here from yesterday's high, this blue box. It literally comes right up to that zone and then comes back down. It doesn't even move more than 1 R. It is a good 2 candle formation. RSI value was good, but where was market sentiment most of the day today? In the sell zone, saying sellers are in control. Higher time frames are, it says bullish, so it feeds that bias, right? Higher time frames are bullish, so you'd think that it would come higher. But 15-minute market sentiment is important, especially with a pair like NZD USD. As of June 2021, NZD USD is not a great pair. I would put it in the same group as USD CAD. Euro pairs and GBP pairs, where most of the markups today have been shown from, they're the ones that have been working well for us the last year. So to me, market sentiment just feeds sellers more than buyers here. So it's not a great formation. The swapping liquid 50 is the big knock. Plus you have the resistance here, getting in the way of getting 2R, and it's a pair I don't like, so I passed on this. This is GBP USD, a pair that we do look to trade, just a lot of zones in its way. Here, you're trying to trade this 3 candle formation through the 21 EMA. It rises for 30 minutes, but it finds resistance at Friday's high. Not only is there resistance at Friday's high, but you've got bearish divergence. That RSI, if you were to blow this up, it's falling and price is rising. So you have so much resistance here from the high of day, from the divergence, from Friday's high. It's a very, very tough trade to take because of that and because the market sentiment line went into the sell zone today. It doesn't matter if it can come higher, as it does by the end of the day. The probabilities at the time of this candle formation were not in your favor. And that's why I would pass on this. It doesn't even go 1.5 R to the divergence line. It's nothing. It's not a great trade to be involved in. Cool. Let's go over some of the questions and then we'll move into the last half of this, last third of this presentation. Okay. So could we say it's less important to knock oversold as 50% weight on the main knock? I wouldn't give it a percentage, Gustavo, so I don't want to give you a yes or no to that. You're being a little too technical for me even. It's just not as important. I can't give you a number to it. I don't want you to hold me to that. How big of a knock are those divergence lines at yesterday's high? Always a knock. That the divergence lines at the high or the low are definitely a knock. If you don't understand that, I would definitely rewatch the presentation once I post the recording. When do you use zones from other days besides yesterday? Not often. Most of the time I'm drawing my zones from the previous day or the lower or high of the week. That's it. We should be aware of price not going above or below the 8 EMA on the 15-minute until it recovers the proper 8 and 21 EMA's order, or the cross should occur with a proper shift candle. If you're trading the D1 in the opposite shift, like I said, the candle should just get above the 8 and hold above the 8, and that will then lead to a shift. Ways to be pickier with entries. That's what we've been talking about the whole time, Michael. When trading into that horizontal resistance, should we wait for prices to break the 15-minute zone or on the 1-minute? When trading into the horizontal resistance, should we wait for price to break that zone on the 15-minute or on the 1-minute? You always want to be trading with zones not in your way. If you ever are trading into a high of day zone, like a yesterday's high or today's high, and you're right into it, it could easily find resistance there and come against you. So I always want to get above or below the level and then trade off of it. I never want to trade into it. If you're trading into it, make sure you can get good risk reward. I hope that answers it, Tim. You're not concerned with the RSI on trend line on the 1-minute, just paying attention to the L50. Good question, Chloe. Exactly. If the L50 is in the buy zone and we get the 50 break on the 1-minute and we have higher lows, I'm buying that. And I know where my stop goes if I'm in the right position on the 15-minute. My question is not very clear. Let me rephrase. How important as a knock are horizontal zones, like yesterday's high, yesterday's low, created by they're a knock. There's something that I would go from a B setup to a C setup. If I can't get 2R to yesterday's high, if it's in my way of getting my 2R, it's something I'm going to take seriously and size down for, because I know it can hit that zone and come off of it. So if I'm trading into it, thinking it's going to go through and give me my 2R with my A size setup, I'm forecasting, I'm not reacting. I hope that makes sense. Thank you for clarifying. Kielne. Good. All right. Answered it, Tim. Good. Good. Felicia, do I ever trade the pullback of the overextended candle? I'll trade the pullback of the overextended candle if there's that 1-minute divergence, so I can call it a D1. Otherwise, I do not trade pullbacks of an A1 unless there's divergence to help it be a D1, because then I can give it the proper stop loss. I will never just, if it's just an A1 formation and it pulls back, I'm never just going to throw a sell in halfway on the pullback. Or a buy. It's never going to happen. If there's divergence on the 1 minute, as there was in that one example, then that's when I would do it. Okay. Good. Covered all the questions. Let's continue. So Dennis, one of the guys who you probably all know, he's been to a lot of our live events. He's very active in the group chat, one of the best traders in the group by far. And that's only something I give him the title of because he works harder than most people, and it shows in his trading results. He wanted me to bring up this idea because I think he, as a friend of mine, was able to bring it to my attention that I'm so locked into my routine, and it's been such a big piece of why I've been so successful that sometimes I overlook it because I'm just so focused, and I finally am living a life that I feel is exactly what I wanted when I got into trading, that I don't talk about this enough. So I want to talk about this stuff with you guys. For me, the saying at the bottom here, how you do one thing is how you do everything. That is like the most important thing when it comes to trading, because if you think about that when you're trading, you'll apply it to the things that you do outside trading. And if you think about it while you're off the desk, you'll apply that mindset into your trading. I think that the big issue that's really a roadblock for a lot of traders is they are not willing to be disciplined enough when it comes to following a routine off the charts. And that then leads to them not being disciplined enough to follow a routine on the charts. A routine being trading at the same time on the small thing, but also in that, I mean, following their trading plan. Discipline is where human beings are not designed to excel. So we have to mentally make the decision to be disciplined. It is that simple. Nothing is different from me to you guys other than I will make the decisions that are harder for me, that align with my discipline more often than you. I challenge you to push yourself into the unknown, so to speak, of making those harder decisions, of making the decisions that require more discipline. If anything, what it does to me is I say, I'm doing this because nobody else will, and because I'm crazy, it motivates me. So whatever you need to do to light that fire, doing the things that'll keep you on routine, following that discipline off the charts will translate into better trading on the charts. I'm a big believer, you guys know, look, I'm wearing a crystal around my neck. You know, for me, the mind and the body have to align in order for us to be our best selves. And I don't want to just be my best self off the chart. I don't want to be my best self just on the chart. I want to be the best version of myself every minute of every day. And the only way to do that is to optimize mind and body. And what I mean by that, first, is to know yourself, meaning certain people like to do certain things that makes them feel great. You should figure out what makes you feel great and do that. Now, I'm not saying it feels great to eat Cheetos and sit on the couch and play video games. I'm saying in the sense of, for example, working out. I love my boxing classes. You guys know I've been doing the boxing classes for like a year now. Riley doesn't like the boxing classes. Riley's a yoga teacher. Riley, her workouts come through yoga classes, different forms of yoga classes. We know ourselves what our body needs to feel great, and we respect each other as you should respect yourself. And that's why I said respect your body, listen to it. I wear the Whoop strap now, and a lot of people think I talk about it too much, probably because it's a workout thing and I'm a trader. Why am I talking about it? It tells me when I sleep good. It tells me when I'm feeling sick before I feel sick. It tells me when I can push myself and go harder and when I should cut it back and take a day of rest. So for me, the more data, the better. And that's why I recommend everybody's wearing an Oura Ring, a Fitbit, an Apple Watch, something to track your data. Otherwise, you're not going to grow. Just like we do our back testing and our chart markups to practice our trading. If we don't do that with our health, we're not being disciplined. We're off routine. We're not showing the discipline we need. And I'm a big believer to finding balance. I'm a big believer in just studying successful people. Take a little bit from everything. Don't ever listen to what I say 100%, because what's working for me 100% will not work for you. You are not me. So you take take a little bit from me what you like, take a little bit from me what you don't like that I'm doing. Maybe I'm drinking too many smoothies. You don't like how many smoothies I drink. You think I should be doing the all meat diet. Do it. If it speaks to you, if it's what your body wants, do it. Take from me, take from other successful people, apply what you like, and know what you don't like so you never try to apply that. Now, specifically, just a couple of pre and post-market tips. For me, the less distractions, the better. Everybody wants to be on the phone every second of the day, especially when we wake up. What did we miss? That's what our brains are conditioned now to say. What do we miss? What do we miss? What do we miss? The first thing that I do every day now is I meditate. I will go on my phone naturally to turn my alarm off if I get woken up by my alarm. Sometimes I don't even wake up by my alarm. I'm up before that. I'll come in here. I won't even turn my screens on. It's a big thing. Don't get the light hitting you right away. Just take the phone, I put it in a little stand, and I do the 10-minute meditation with the Waking Up app. Check out Sam Harris, check out the Waking Up app if you need a little guidance. Do it with Headspace, do it with whatever. But I think all of us here are so similar in a way with our alpha mindset, our overachiever mindset, our wanting for more, our passion, our motivation. You and I are so similar, all of you guys that are watching this. I would probably guess that most of you will benefit from the meditation more than not. It'll slow you down. It'll get you waking up. It'll get you thinking properly rather than rushing to the chart to see if you are about to miss a trade and you need to show up. The Waking Up app takes 10 minutes. One 15-minute candle takes 15 minutes. There's no reason not to do it. So I think meditation will calm the mind and get you prepped, not just for a great trading day, but for a great day overall, finding that balance. So working out, I'm going to talk about that. I'm going to say that all of that stuff is important. I'm not here to tell you what to do, guys. I'm not your fitness coach. I'm not your guru. I'm here to help you trade. But I can guarantee you, if you take care of your body and your mind off the desk, it will improve your trading. The more you stop watching Netflix, the more you start watching some educational YouTube videos about psychology, why you think the way you think, the more that you shift into a mindfulness-focused life, I think your trading will get better. But if you don't want to do that, don't be surprised if your trading results aren't where you want them to be. And I think the last piece that I want to leave you with here today is that the outcomes of the trades that we take, we just went over a lot of winners and a lot of losers. The outcomes of these trades are not important. Staying on edge, following the back testing that we've done is the most important thing. If you go off the edge, you are basically gambling. If you trade an A1 formation when it's not off the 21, it is more of a gamble than if you were to stay on edge. And I don't think anybody in here has committed this much to their trading. You've probably watched other courses, other videos. You wouldn't be here if you were trying to gamble. You're trying to take this seriously. So focus on the process, the steps, the questions, the checklist that you're using before the trade rather than the outcome of the trade. Because I'm going to just take a guess that all of us are not trading the amount of money that at some point in the future we would like to be trading. So why are we focused on the dollars that we're making today instead of the process to get us to that bigger account? So let's just recap quickly. The A1 entry has to come off the 21, has to be on there with a body, not with a wick, and do not enter mid-candle. I don't know how else to say it to make it clear. I'm hoping that after watching this, you guys understand that very clearly now. The D1 entries, the 1 minute liquid 50 is so important for entry and exit. If you're buying, wait for that 1 minute liquid 50 to get into your zone in the buy zone. If you're selling, wait for it to be in the sell zone and use the 50 EMA on the 1 minute, those retests to identify your price structure, and the stop will always go with the most recent structure point. For risk management, no trade is worth all of your account or 20% of your account or 10% of your account. So the most important thing that you do, because we do not know the outcomes of the trades, the most important thing that you do is control the risk per trade. No matter what you're feeling, the meditation will help you feel those feelings even more and create space from them to not let them impact the decisions you make. So if you're impulsive, you need to meditate more. It will help you, I promise. It's not some corny rah-rah thing. Sitting with yourself for 10 minutes every morning is going to help you be more mindful of your decisions, and it's going to help you feel your emotions more so you know, okay, I'm off edge, let me get out of this trade. Not, I'm off edge, let me hope and make this right. You'll be able to be aware of that hoping and dissect it and say, this isn't what professional traders do. Let me get out of this trade. Let me make the logical decision, the business-focused decision. And again, nothing is worth a large position of your account because we don't know the outcomes of those trades. So everybody's loving it. We got nuggets in the chat. We got nuggets. Everybody's feeling good. Awesome.